All right, everyone, welcome. Today, we're going to talk about something that might just challenge the very foundation of what you're learning in this room. We're talking about the system of double-entry bookkeeping, an idea that's been around for over 500 years. And we're going to explore a new concept that could literally reshape your entire career.
So let's just jump right into the big question. You're all here learning the principles of accounting. But is the system we're teaching you actually built for the world you're about to graduate into? I mean, think about it. So let's start with the basics, the accounting 101 stuff you all know, and see where the cracks are starting to show.
To really get this, we've got to go way back. We're talking Renaissance Italy. A brilliant system was born there, one that has served commerce incredibly well for centuries. But in today's global, high-speed digital economy, well, it's starting to strain a bit under the pressure.
The year is 1494. A Franciscan friar, Luca Pacioli, writes down the system of double-entry bookkeeping. You guys know the drill. For every debit, there's an equal and opposite credit. It's beautiful, right? It's this perfect, elegant, self-correcting little universe where assets always equal liabilities plus equity. It is a perfect system for a single company.
Okay, so here's the rub. The system is amazing for making sure your own house is in order. But what happens when you do business with someone else? Company A's books are perfectly balanced. Company B's books are also perfectly balanced. But there is absolutely nothing that mathematically guarantees their records of the same exact transaction actually match. And that's what we call the trust gap.
And this gap, it isn't just some academic idea. It has massive real-world consequences. Honestly, it's the entire reason most of you will have a job. We spend billions, literally billions, on reconciling accounts, on auditors, on banks, all of these intermediaries whose main job is to bridge that gap, to prove that my version of the truth is the same as your version. But what if we could just get rid of that gap entirely?
So the big idea to solve this is called triple entry accounting, or TEA for short. Now, here's where you got to pay attention because it gets a little confusing. The term gets thrown around to mean two totally different things, concepts that popped up decades apart. So let's pull them apart so we're all clear on what we're talking about.
First up, you've got Yuji Ijiri's concept from way back in 1986. He called it momentum accounting. It's a really smart academic idea about adding a new layer of analysis for managers inside a company. Then, almost 20 years later, a cryptographer named Ian Grigg comes along with a totally different take. His idea isn't about internal analysis. It's all about closing that trust gap between companies using a shared cryptographic receipt. We're going to focus on Grigg's model, because that's the one that's really shaking things up today. Now, Ijiri's idea was pretty wild for its time. He was thinking like a physicist. He said, it's not enough to know your income, your speed. You need to know your acceleration. Are you hitting the gas or are you slamming on the brakes? The technology just wasn't there in the 80s to make it practical, but now with big data and AI, his ideas are starting to look pretty interesting again. Grigg, though, he was coming at this from a completely different angle. He wasn't trying to add another column to your spreadsheet. He wanted to create undeniable proof. In his model, the third entry isn't just another number, it is the transaction. It's a shared, dominant record that takes us from my version and your version to simply the version. It becomes a single source of truth. Okay, so how does this actually work in the real world on a blockchain? Well, that third entry is essentially a super secure digital data packet, that shared receipt we've been talking about. Let's pop the hood and see what's inside. So you've got the basics in there, who, what, when, and how much. Standard stuff. But here's where the magic happens. It also contains the digital signatures from both the payer and the payee, like they've both cryptographically signed off on it. Then there's a secure timestamp. And finally, this thing called a cryptographic hash. Just think of it like a unique digital fingerprint for the transaction. And here's the really cool part. That fingerprint is mathematically linked to the fingerprint of the transaction before it, which is linked to the one before that, creating an unbreakable chain. And what this creates is what Grigg called a bulletproof accounting layer. This is a huge shift. Right now, auditors hunt for fraud by looking for procedural clues, things that just don't feel right. In this new world, you don't have to hunt. The fraud announces itself. If someone tries to change the past, they break the math. And the broken chain is right there for everyone to see. Fraud becomes mathematically detectable. Okay, so this isn't some far-off sci-fi concept. This is happening right now. And for all of you, this is the world you're about to step into. Let's check out a couple of real-world examples of how companies are using this today.
Take a protocol called Request Network. They're using this for invoicing on the Ethereum blockchain. So instead of one company logging invoice sent and another company later logging payment received, the invoice and the payment become one single shared event. You see the difference? It's not two separate actions in two separate books anymore. It's one shared truth. Think of all the arguments about, did you get my invoice or when did you send the payment? They just vanish. And if you want to see the payoff, get this. The Sandbox, the big metaverse platform, used this to handle payroll for their contractors. The result? They cut the time they spent on payment reconciliation by 90%. 90%. Why? It's simple. There was nothing to argue about. The shared record was the undeniable proof for both sides. Just take a second and imagine what your future employer could do with 90% of their reconciliation time back.
And it goes way beyond just payments. You've got platforms like Audit Chain that are trying to basically put the entire audit process on autopilot. They've even created these things called Pacioli nodes. A nice little nod to the old master, right? And these nodes act like little robot auditors, working 24/7, checking every single transaction against accounting rules in real time. It's a continuous audit, no more waiting till the end of the quarter.
So this all sounds pretty amazing. Continuous assurance, no reconciliation. So why isn't every company on the planet doing this tomorrow? Well, as you're all going to find out in the professional world, it's never that simple. There are some major hurdles we have to get over. The first big one is the Oracle problem, or as I like to call it, garbage in, immutable garbage out. Look, a blockchain is fantastic at locking down data and making sure it can never be changed, but it has zero idea if that data was correct in the first place. It can prove I paid you for a shipment of apples. It has no clue if I actually delivered the apples or if they were all rotten. If you put bad information onto the blockchain, you just get a perfect, permanent record of garbage. Next up, speed, or really the lack of it. Just look at these numbers. A major public blockchain like Ethereum can process maybe 15 transactions per second. 15. Visa, on the other hand, cruises along at around 24,000. That's not a small difference. That's a different universe. You simply can't run the global economy on a system that's slow. It's a huge technical problem they're still trying to solve. And then there's all the other messy real-world stuff. You've got regulations like Europe's right to be forgotten, which directly contradicts a blockchain's never forget design. You have massive companies that have poured billions into their existing SAP and Oracle systems. They're not just going to rip all that out overnight. And you've got this fundamental conflict. Blockchains are built on transparency, but businesses need privacy. It's a real tug of war. Now, let's bring this all back to you. If you are planning a career in audit, this is absolutely critical. Your profession is going to change big time. It's going to shift from looking backward at samples of past transactions to providing assurance on the systems that operate in real time. The question you'll be paid to answer won't be, was this one entry recorded correctly? It'll be, does the code that runs this entire system always record transactions correctly? It's a totally different skill set. So this brings us to a final thought. By moving trust from human intermediaries to pure mathematics, triple entry accounting doesn't just change the ledger, it changes the professions that are built around that ledger, including yours. So the question I want to leave you with today is not if this change is coming. It is. The question is, are you prepared for it? Will you be the accountants who just record the past, or will you be the architects who help build this new future? Thank you.